De Beers will suspend operations at the Venetia diamond mine in South Africa for 2 years as it continues to navigate challenging market conditions by cutting costs and reducing production. Here's why this is such a significant announcement and move by De Beers. You're watching Pressing Matters with Avi Kravitz. Now, this move by De Beers is not simply about a weak diamond market, although that's the main cause. It tells us a lot about where the company is heading and what a potential buyer is likely to inherit. For context, if you're not aware by now, De Beers is up for sale. Anglo American is said to be in the final stages of selling its 85% stake in De Beers, so it's interesting timing to make this announcement. De Beers CEO Al Cook said a few weeks ago that the sale could be closed within a matter of weeks, and there are reportedly 3 groups that have submitted final bids. So indeed, why now? The first possibility is that you run a company regardless. Companies respond to market conditions, and this move needed to be made. De Beers has been cutting costs through its Origins strategic program over the last 2 years and has removed more than $100 million worth of annual overheads from the business in that period. Secondly, we have to look at Venetia itself. This is not an insignificant mine. It yielded 2.2 million carats in 2025, and De Beers has invested around $2.3 billion to develop underground operations where production officially began in 2023, extending the life of the mine to at least 2045 with expected production of around 80 million carats during that lifespan. So De Beers saw a future in Venetia, which is the only mining operation it has left in South Africa. Venetia is operated through De Beers' local subsidiary, the De Beers Consolidated Mines Division, with a profit share to its Black Economic Empowerment partner. The issue with the mine is the profile or mix of its production, which to my understanding is predominantly lower value and smaller goods for which demand significantly dropped in the last 3 years. And we see that in its numbers. The average price achieved by De Beers in South Africa, which is essentially Venetia, peaked in 2022 at $134 per carat and declined to just $66 per carat in 2025. In 3 years, it more than halved the value of its production. At the same time, costs were climbing. Fuel, wages, general inflation, all increased expenses. Underground mining is inherently more expensive than open pit mining, and the slightly stronger South African rand only added to the pressure from weaker dollar-based diamond prices. In 2022, De Beers paid $42 a carat to earn $134 per carat from its sales of Venetia production. That's the profit margin of around 220%. In 2025, it paid $110 per carat for a sale of $66 per carat. De Beers Consolidated Mines ran at a loss in the last 2 years, with earnings before interest and tax showing a loss of $187 million in 2025 and $126 million in the red the previous year. And I suspect that continued in the first half of this year. We'll see when Anglo reports its earnings on July 30th. So we see what a drag on earnings Venetia has become. And by the way, the same dynamic is playing out at the Gahcho mine in Canada, where De Beers shelved an expansion project and brought forward its closure date to 2028. Don't be surprised if that date is brought forward even closer to next year. Of course, all of this isn't unique to De Beers. We've seen a slate of diamond mines being suspended or closed in the last 3 years, most recently by Petra Diamonds with its Finch mine, the Kayo mine in Lesotho. I could go on. The point is that diamond prices have declined to the extent where mines with a certain profile of production no longer make economic sense, and that affects junior miners and the majors. No one is immune. And that brings us back to our original question: why now? In fact, it begs a deeper question. What would a potential buyer do with an asset such as Venetia, where the value is based on the potential return to production if and when market conditions allow in supposedly 2 years' time? And there's another dimension to which the suspension of Venetia affects the sale of De Beers, and that is its funding. In 2022, De Beers secured a 10 billion rand credit facility, that's about $600 million, from a syndicate of banks to fund the completion of the Venetia underground project, with Standard Bank of South Africa providing 4 billion rands worth as the lead lender. From what I understand, the facility was raised at the De Beers group level rather than the South Africa business unit, De Beers Consolidated Mines, that operates Venetia. If that is the case, the debt sits with the group and isn't dependent on sales from the mine itself, even though funds were raised to finance the underground project. With Venetia now on pause and capital spending being pushed back, the financing becomes another piece of this Anglo-De Beers sale puzzle. Whether the eventual buyer refinances the facility, assumes it, or requires it to be repaid before a deal closes is something we'll have to watch. The more important point for me, though, is that the buyer will inherit a large dormant asset. It may demonstrate more value being inactive than having to maintain a loss-making operation in the current market environment, but it is just sitting there nevertheless. So there is a question of why now. But I think the move is more a sign of the time and a repositioning by De Beers as we're seeing across the diamond and jewelry pipeline. In fact, the why now question may well alert us to the pending sale. But there are other issues that the suspension of Venetia operations raise. Venetia employs over 4,000 people, which is a tremendous human cost in an area where the mine is extremely important, sustaining the community with jobs, schooling, healthcare, etc. These decisions are not to be taken lightly, and it will no doubt bring the unions into the picture. The final point that we need to be aware of is that De Beers framed the announcement as part of an ongoing broader restructuring. Its press release concluded by saying De Beers plans to reconfigure its global operating model to refocus and prioritize resources on the core operational businesses and reduce its central corporate cost base. That's a lot of corporate jargon. It's basically saying that it's planning further reorganization of the business and to focus its resources on its core operations while reducing head office costs. This story is not over. As I said, I think we'll hear about Gachokwe sooner than we think. Long term, De Beers mining operations will be where the value lies, and that is in Botswana and Namibia marine operations. And then there are a host of other business units that De Beers is clearly rethinking. I've said before, De Beers in 30 years' time will be a vastly different company than it is today. And in fact, it will be a very different company even in 3 to 5 years. So brace yourselves for more. I think this is a precursor to the sale announcement whenever it comes, but it's also sending a message to the rest of the diamond trade because it still holds that as goes De Beers, so goes the diamond industry. De Beers is telling us there's too much production, too much supply. It's profitability that matters rather than revenue. So cover your costs and be willing and prepared to make difficult strategic decisions. Let me know what you think. There's a lot to digest. Like and subscribe to my channel. The support really helps. Check out the Diamond Press for more news and analysis about the diamond market. And check out my latest research report, which explores the value of De Beers as fate would have it. Thanks for watching. I'm Avi Kravitz. I'll see you next time.